Imagine the silence of your kitchen table on a Tuesday morning, a silence broken only by the sound of tearing paper as you open a standard white envelope from the Internal Revenue Service. You aren't worried, or at least you tell yourself you aren't, because you are careful. You are the type of investor who values privacy above all else, the person who deals in physical assets precisely because you believe they exist outside the system. You pull out the letter expecting a routine notification, perhaps a minor adjustment to a refund, but your eyes lock onto a single phrase in the second paragraph that makes your stomach drop to the floor. It references a discrepancy in reported income matched against third-party documentation regarding the sale of precious metals 3 years ago. You freeze. You distinctly remember that sale. You remember walking into the local coin shop, handing over the silver and taking the check. You remember checking the rules and being absolutely certain that the dealer did not file a Form 1099-B because you stayed just under the quantity threshold. You thought you were invisible. You thought you were a ghost in the machine. But looking at that letter, with the realization of penalties and interest compounding over 36 months, you suddenly understand the terrifying reality that most silver stackers will not accept until it is too late. You were never invisible. In fact, by trying so hard to hide, you lit a flare that the IRS has been watching burn for years. You are standing inside the digital fence and the gate just locked behind you. Welcome back to Growth Grid, where we strip away the paranoia and replace it with the cold, hard data of financial survival. In our last discussion, we introduced the concept of the digital fence, that invisible, systematic legal architecture being constructed around every exit ramp from physical silver back into the fiat dollar system. The response was overwhelming, but the anxiety was palpable. The comment section wasn't just filled with questions, it was filled with fear. Everyone understood the trap, but nobody knew the combination to the lock. The questions were identical. Am I already flagged? How do I know if my transactions are visible right now? And most critically, what specific actions can I take today, before the laws tighten further in 2026, to ensure that this fence protects my wealth rather than confiscating it? Today we are going to dismantle the ambiguity. We are going to walk through the fire of regulatory surveillance, but we aren't doing it with general theories or vague warnings. We are going to do it with the specific rules, the exact dollar thresholds, the specific product choices, and the behavioral frameworks that determine your financial fate. This is not about fear-mongering. This is about the highest level of financial literacy available to the modern investor. The reality is that the digital fence does not affect every silver owner equally. Two investors can own the exact same amount of silver, sell it on the exact same day for the exact same profit, and face completely different futures. One walks away with their wealth intact and their privacy respected. The other walks into a devastating audit that wipes out years of gains. The difference is not luck. The difference is understanding the mechanism. To truly understand how to navigate this, we have to move beyond the dry text of tax law and look at the human behavior that triggers the algorithms. We need to look at the three overlapping surveillance systems that make up the fence. System 1 monitors how you pay when you buy. System 2 monitors what you sell and the quantity of that sale. System 3 monitors your bank account for what is called lifestyle patterns that suggest undisclosed income. These systems operate independently, which is why they are so dangerous. You might successfully navigate one only to be caught by the other. But when they cross-reference their data, they create a net that is tighter than any single reporting law could ever be. To make this concrete, to make you feel the weight of these decisions, we are going to follow the lives of two specific investors over a 3-year period. Let's call them Investor A and Investor B. We are going to watch every move they make, see the invisible data trails they leave behind, and witness the catastrophic difference in their outcomes. Let's go back in time to 2023. Silver is hovering around $28 an ounce. Both Investor A and Investor B decide to allocate a significant portion of their portfolio to physical silver. They both have $40,000 to deploy. Investor A is what we might call the privacy purist. He believes that the banking system is the enemy. He believes that if he uses a digital payment method, he is putting a target on his back. So he adopts a strategy that he believes is clever. He decides to buy exclusively from a local coin shop, and he decides to pay exclusively with cash. He knows about the $10,000 reporting threshold for Form 8300, the form that businesses must file if they receive more than 10 grand in cash. He wants to avoid that form at all costs. So Investor A goes to his bank. He doesn't withdraw $40,000 at once. He knows that would trigger a report. Instead, he withdraws $8,000 on a Tuesday. He waits a week. He withdraws another $9,000. 2 weeks later, another $7,000. He takes this cash to the coin shop and buys generic silver bars, simple, low-premium 99.9 fine silver. He thinks he has beaten the system. No single transaction triggered a form. No paper trail connects his identity to the metal. He feels safe. Now look at investor B. We'll call him the systemic pragmatist. He has the same $40,000. He goes online to a major bullion dealer. He places a single order for the full amount. He pays via a standard bank wire transfer. He buys a completely different product. He buys American Silver Eagles exclusively. He creates a massive paper trail. The bank records the wire, the dealer records the invoice. The shipping company records the delivery to his home address. To investor A, investor B looks reckless. Investor B looks like a sheep walking into the slaughterhouse. But here is what is happening inside the servers of the banking system, completely invisible to both men. When investor A started making those cash withdrawals, 8,000, 9,000, 7,000, he triggered a silent alarm in the bank's fraud detection software. The bank's algorithm flagged the pattern. It saw a customer who normally pays bills and buys groceries suddenly draining liquidity in amounts that were just below the federal reporting limit. This behavior has a legal name. It is called structuring. It is the intentional manipulation of transaction amounts to evade reporting thresholds. It is a federal crime punishable by up to 5 years in prison, regardless of whether the money is being used for legal or illegal purposes. The bank did not call investor A to ask why he was withdrawing the money. They are legally forbidden from tipping him off. Instead, the compliance officer at the branch reviewed the pattern, saw the classic signs of structuring, and filed a suspicious activity report, or SAR, with the Financial Crimes Enforcement Network, or FinCEN. This report detailed investor A's personal information, his account history, and the specific dates and times of his withdrawals, flagging him as a potential money launderer or tax evader. That report was uploaded to a permanent federal database. Investor A walked out of the bank feeling like a ghost, but he had just created a permanent searchable flag on his financial identity that would sit dormant, waiting for a trigger. Meanwhile, investor B's wire transfer went through the system effortlessly. It was a large transaction, yes, but it was transparent. It went from a known entity to a known precious metals dealer. There was no attempt to hide, no attempt to manipulate the amount. The bank's algorithm looked at it, categorized it as a high-value retail purchase, and moved on. No flags, no suspicious activity report, no darkened mark on his profile. By trying to be invisible, investor A made himself a target. By accepting visibility, investor B remained effectively anonymous within the noise of the system. This is the paradox of the digital fence, that the more you squirm to escape it, the tighter it grips you. Fast forward 3 years to early 2026. Silver has exploded in value. It is trading near $90 an ounce. Both investors are sitting on a massive profit of roughly $62 per ounce. They both decide it is time to sell a portion of their stack to realize those gains. This brings us to the second surveillance system, the dealer reporting rules. This is where the product choice made 3 years ago comes back to haunt investor A. Investor A walks back into the coin shop with his heavy bag of generic silver bars. He wants to sell 900 ounces. He checks the rules on his phone before he goes in. He knows that the dealer is required to file Form 1099-B if the customer sells 1,000 troy ounces or more of silver bars in a single transaction. He smiles. He is selling 900 ounces. He is safe. He makes the sale, takes the check, and walks out. No tax form is handed to him. Once again, he feels like a genius. But greed gets the better of him. 2 weeks later, seeing the price dip slightly, he decides to sell another 200 ounces to the same dealer. He assumes that because this is a separate day, a separate visit, and a separate transaction, the counter resets. He is wrong. The IRS aggregation rule is not limited to a single handshake. It applies to related transactions within a 24-hour period by statute, but the anti-structuring provisions allow dealers to aggregate transactions over a much longer period if they believe the customer is trying to dodge the reporting requirement. The dealer system flags investor A. The dealer sees that this customer has sold 1,100 ounces total within a short 30-day window. The dealer, wanting to protect their own business license and avoid being accused of facilitating structuring, aggregates the sales. They file Form 1099-B for the total amount of the combined sales. They mail a copy to the address investor A provided, but perhaps it gets lost, or perhaps investor A ignores it, assuming it's a mistake. The copy that matters goes straight to the IRS Data Matching Center. Now look at investor B. He decides to sell 1,200 American Silver Eagles. He goes to the same dealer or mails them to the big online exchange. He sells the entire lot in one massive transaction. The total value is well over $100,000. He waits for the tax form. It never comes. Why? Because American Silver Eagles are legal tender coins. Under the current IRS statutes, they are exempt from Form 1099-B broker reporting requirements, regardless of the quantity sold. You could sell 10,000 of them in a single day, and the dealer has no federal obligation to file a 1099-B. Investor B's sale is completely silent in terms of third-party reporting. Note that this does not mean the tax isn't owed. We will get to that. But it means the automatic surveillance mechanism that tripped Investor A does not exist for Investor B. Same profit, same metal, completely different visibility, all because of the stamp on the coin. Now we arrive at the final and most devastating phase, the audit. It is tax season following the year of the sale. Investor A is filling out his tax return. He looks at his records. He knows he sold the silver. He knows he made a massive profit. But he thinks, nobody knows. I bought with cash. I sold in batches. The government has no idea this money exists. He leaves the capital gains section of Schedule D blank. He files the return. 3 months later, the IRS computer system runs its automated matching program. It compares the income reported on Investor A's tax return against the documents received from third parties. It finds the Form 1099-B filed by the dealer for the aggregated sale of the generic bars. The computer flags a mismatch. An inquiry letter is automatically generated. Investor A receives the letter. He panics. He tries to claim it was a mistake. The IRS assigns an agent to open a limited scope audit. But audits are like pulling a loose thread on a sweater. Once they start, the whole thing unravels. The auditor pulls Investor A's full file. And this is where the trap snaps shut. The auditor accesses the FinCEN database and sees the suspicious activity report from 3 years ago, the weird cash withdrawals. Now, the auditor doesn't just see a mistake on a tax return, they see a pattern of behavior. They see a taxpayer who structured cash withdrawals to buy untraceable assets, then structured sales to avoid reporting, and then failed to report the income. The investigation expands from a simple math error to a potential criminal tax evasion case. The auditor asks Investor A for proof of his cost basis. You sold these bars for $90,000, the auditor says. How much did you pay for them? Investor A paid cash. He didn't keep the receipts because he didn't want a paper trail. He has no bank statement proving the purchase because he used cash withdrawals. He has nothing. The auditor applies the zero basis rule. Because Investor A cannot prove he paid $28 an ounce, the IRS treats the purchase price as zero. The entire $90,000 is treated as pure profit. The tax bill is calculated not on the gain, but on the revenue. Then come the penalties, the accuracy-related penalty, the failure to pay penalty, and the interest. Investor A ends up owing nearly half the value of his stack to the government, plus legal fees to keep himself out of jail. Investor B, on the other hand, sits down to do his taxes. He received no 1099-B. He knows the IRS has no direct record of his sale. But Investor B is playing the long game. He reports the sale on Schedule D. He reports the full capital gain. He pays the 28% collectibles tax rate. It hurts to write the check, but he writes it. A year later, perhaps he gets randomly selected for a review. The IRS looks at his bank account. They see a huge wire transfer coming in from the dealer. They look at his tax return. The numbers match perfectly. The inquiry ends before it even begins. Investor B keeps 72% of his massive profits, sleeps soundly at night, and has a perfectly clean record for the next bull market. This story illustrates the digital fence in practice. The fence is not designed to stop you from owning silver. It is designed to catch you when you try to move back into the dollar system using the old rules of anonymity. So how do you modify your behavior starting today? I'm going to give you the growth grid framework. 5 specific decisions you must make to protect yourself. Framework decision number 1 is that you must completely rethink your relationship with payment methods. The old advice of cash is king is dangerous in a surveillance economy. Always use traceable payment methods for silver purchases, personal checks, bank wires, credit cards, or ACH transfers. I know this sounds counterintuitive to the privacy-minded investor. You are thinking, why would I want a record? You want the record because the alternative is worse. None of these digital methods are classified as cash under Form 8300. You can wire $100,000 to a dealer, and it does not trigger the cash reporting form. More importantly, it does not trigger the structuring algorithms at your bank. The privacy you think you are getting with cash is an illusion because the cash has to come from somewhere. The withdrawal is the flair. By using a wire, you create a clean, boring, standard transaction that disappears into the ocean of digital commerce. You avoid the suspicious activity report, which is the most dangerous weapon in the IRS arsenal. Framework decision number 2 is that you must become a sniper with your product selection. You need to know exactly which items trigger the selling thresholds. If you are stacking for a massive revaluation for a time when silver hits triple digits, you must understand that American Silver Eagles offer a liquidity advantage that generic bars do not. The exemption of Eagles from Form 1099-B reporting is a massive strategic advantage. It gives you control. It means that when you sell, the reporting responsibility lies with you, not the dealer. It prevents the automatic cross-referencing of your data. Generic bars, 100-ounce bars, and kilos are fantastic for accumulating weight, but they come with a reporting liability at the exit. If you hold these, you must be aware that selling more than 1,000 ounces at once will trigger the form. Plan your exit strategy accordingly. Do not mix these products in your portfolio without understanding that they have different exit doors. Framework decision number 3 is that you must understand the aggregation rule. This is the snare that catches the people who think they are smarter than the dealer. Both Form 8300 on the buying side and Form 1099-B on the selling side contain provisions that require transactions to be combined. If you buy $9,000 of silver in the morning and $2,000 in the afternoon, that is one transaction in the eyes of the law. If you sell 500 ounces on Monday and 600 ounces on Tuesday to the same dealer, that is one transaction. Do not try to smurf your transactions. Dealers are trained to spot this. They are fearful of losing their business licenses. If you act suspicious, if you ask what is the reporting limit and then adjust your order to be $1 below it, they will file a report on you immediately. Be blunt, be transparent, and either stay well below the limits legitimately or exceed them boldly. The middle ground of manipulation is where the legal danger lies. Framework decision number 4 is that you must document your cost basis as if your financial life depends on it, because in an audit, it absolutely does. This is the single most boring and most critical advice I can give you. When a dealer files a 1099-B, they report the proceeds, which is the gross amount of the check they wrote you. They do not report what you paid. The IRS computer sees proceeds of $100,000. It assumes profit of $100,000. It is up to you to prove otherwise. If you bought that silver 10 years ago and lost the receipt, you have no proof of basis. The IRS will legally assign a basis of 0. This is the nightmare scenario. You need to create a silver ledger today. Open a spreadsheet. Columns for date of purchase, dealer name, product type, quantity, total price paid including shipping and premiums, and payment method. Scan every receipt. Save every email confirmation. If you bought privately or with cash years ago, find any contemporaneous evidence, a withdrawal slip, a calendar entry, a diary note. Anything is better than nothing. This spreadsheet is your shield. When the auditor asks how much did you pay, you slam that binder on the table. That is the difference between a tax bill of $30,000 and a tax bill of 0. Framework decision number 5 is to report your gains accurately. This is the decision that makes the other 4 frameworks work. The digital fence is an algorithm designed to find the gap between what the system sees and what you say. Bank deposit monitoring, data matching programs, suspicious activity reports, all of these feed into a central brain that looks for income that appeared in your life but didn't appear on your return. If you report your silver gains accurately, that gap does not exist. The fence closes around the people who are trying to slip through it. It does not close around the people who are on the right side of it. I know nobody likes paying taxes. I know the philosophy of it's my money, it's outside the system. But we are talking about risk management. The cost of the tax is the insurance premium you pay to keep your wealth and your freedom. The penalties for evasion, the stress of an audit, the legal costs of defense, these far outweigh the capital gains tax. Now, I know the question sitting in the back of your mind, it's gnawing at you. What about the silver I already bought with cash? What about the gains from previous years that I didn't report? Am I already cooked? I cannot give you legal or tax advice for your specific situation. I am a researcher, not your CPA. But I can tell you the general principle of tax law. Voluntary disclosure is always, always better than discovery. If you realize you have exposure, if you have undocumented cash stacks or unreported sales, sitting and hoping is not a strategy. The IRS has a long memory and very slow computers, but they eventually finish the calculation. Amended tax returns are a legitimate legal mechanism. Consulting with a tax professional who specializes in precious metals and saying, "I want to clean this up before they find it," is often the move that saves you from the 75% fraud penalties. It puts you back in control of the narrative. Let's bring this all together. The digital fence is tightening. By 2026, with the advancements in AI-driven tax enforcement and the potential rollout of central bank digital currency pilots, the windows of anonymity will be sealed shut. The days of the Wild West silver stacker are ending. But that does not mean the opportunity is over. It means the game has evolved. The winner in the next phase of the silver market is not the guy burying tubes of eagles in the backyard and hoping the world forgets he exists. The winner is the investor who operates with the precision of a forensic accountant. The winner is the person who uses traceable wires to avoid bank flags, who buys eagles to control their exit reporting, who keeps impeccable records to defend their cost basis, and who reports their gains to neutralize the threat of an audit. Be investor B. Be the person who sleeps soundly while the price of silver skyrockets, knowing that no letter from the IRS can hurt you because you have the documentation to prove every single ounce. You are building wealth for your family, not building a case for the prosecution. This is the Growth Grid way. We deal in reality. We deal in logic. We don't sell fear. We sell the roadmap through the minefield. If this breakdown gave you clarity that you couldn't find on the hype channels, if it made you rethink your strategy, hit that subscribe button. We are going to keep peeling back the layers of the financial system every single week. Drop your questions below. I want to know which side of the fence you're building on. I read every single comment. Stay logical, stay documented, and I'll see you in the next one.